Good morning and welcome to Bazaar Morning Call. I am Anuj, with me, Sonia and Prashant. Good morning, Sonia, Prashant.
Hi, morning.
It's Wednesday, which means just one day prior to that weekly expiry day where the markets normally make a big move. But the big move already happened yesterday, of course. The global markets clearly in a bit of a risk-on mode. Of course, for us, inflation remains a bit of a risk. We'll talk about that. The daily petrol and diesel prices have resumed. 80 paise per day may not sound a lot, but added up over 5 or 6 days, it will be a lot. We'll find out, of course. Yesterday, the key highlight was that the Nifty touched the 200-day moving average and bounced like a spring and ended at the highest point of the day. So is it a fresh uptrend? We'll find out. For starters, the SGX Nifty is indicating that we'll have a good start. Sonia, hi.
Hi, good morning. Hi, morning, Prashant. Many questions on the mind, right? But of course, very positive handover from across the globe, which is a good thing for the bulls. The Dow is well in the green. The Asian markets are well in the green right now. The last time I checked, Nikkei was up almost 500 points. Oil prices have cooled off a little bit to whatever extent, we've seen right now. So I think $115 a barrel is where oil prices are seeing a pivot. Gold has slipped to a one-week low as well. So that's when risky assets come back into action. And FIIs, they sold in the previous day. So yesterday that selling has turned to buying, which I think is a good thing. A small amount nevertheless, but buying to 400 crores over there. So two questions, right? This 200-day moving average of 17,000 thereabouts, does it form a firm support now for the market, at least in the very near term? And second, there were three big concerns that this market had: the war, higher inflation, and COVID. Have global markets priced all of that in, or at least, a maximum of these cues? Has it been priced in?
Yeah, but on COVID, the market wants to price in whether it leads to economic disruption or not. The market doesn't care about, the human angle of it. So I think that's something which is very difficult to deal with. Sonia, I just focus on price action, and it's a very remarkable price action on the Nifty over the last 3 days. If you see the high of the Nifty, it's been almost same, 17,350 thereabout. 17th March was 17,344, 21st March was 17,353, and yesterday, even though we closed at the highest point of the day, it was 17,334. The low has been getting lower by almost 100 points, 17,175, 17,096, and 17,006. Why is that important? It's because has this market sort of tried to give a bit of a false breakdown, remove the weak hands, and is now ready to march on? I think that's a possibility. Also because yesterday you bounced right from that 200-day moving average, not even a point here or there. The well-documented congestion zone that I spoke about, 17,300 to 600, can we take that out? At 17,500, the Nifty will complete a 66% retracement of the fall from January highs. So in that sense, it will no longer be just a sort of recovery. It could perhaps be a fresh up move, because yesterday's move looked promising. My sense is that looking at the kind of open interest that we have, a lot of people still don't believe in this rally. 17,400 to 17,600 calls have seen high open interest, and it's possible that the market makes a bit of a mockery of these. A lot of people would try to short this move, and it's possible that the market, in its own wisdom, decides to just make a dart to 18,000, 18,200. It's happened in the past. It can very well happen. The only problem which I see is a bit of a stagflation risk, which is there for India. Inflation is going up, will go up. Not just petrol and diesel, gas prices are going up. You've seen, in your daily routine, if you go out in the market, you see, that inflation is inching up. And obviously, whether growth will also catch up or not, we'll find out. That's a bit for risk, but that's for the medium term. In the near term, everything is driven by sentiment, and sentiment right now is very positive. But Prashant, morning, what's the global setup looking like?
Absolutely. Good morning, guys. So, impressive rally, right, overnight. Yeah. US markets doing very, very well. And this came in the face of sharply rising nominal rates and real rates as well. So, both nominal and real interest rates, market interest rates, went up. Now, that is surprising to many, and it's a puzzling time for many who watch, how bond markets and equity markets work. So the S&P 500 was up about 1.25%. Nasdaq was up nearly 2% or so. What happened to rates? The 5-year went up 8 basis points to 2.4. The 10-year went up 9 basis points to 2.38. Many, and you will continue to hear this, and we'll try and sort of talk about this in greater detail later, but you will start to hear a lot of people talking about the yield curve inversion. I mean, you can look at many pairs. You can look at the 2 to 10, which is the 2-year to 10-year. You can look at the 5 and 30. I mean, it depends what you look at. But the point is, generally speaking, a yield curve inversion, which is basically the 2-year, for example, the 210, the 2 yielding more than the 10-year, has historically sparked off a recession. And that is the talk, I think, which is dominating global markets, US markets especially. Now, this is all in the US. And even having said that, the point is, it's a signal. I remember very clearly this, I think, obviously not very clearly because I don't remember the exact time. The first time this happened in 2000 pre-GFC. It happened, I think, in late 2005 or early 2006. The first time the yield curve inverted, I mean, the rally went on, right? You only finally got a global financial crisis-led recession 2 or 3 years later. So the lead lag could be significant. It does not tell you how shallow or sharp the recession, etc. is. But it's a topic of conversation which I think will pick up steam with this move that we are seeing in interest rates, market interest rates. Oil was, I mean, as you guys said, around about 1%. It's still elevated, too high for comfort, $115 a barrel. And the Russia-Ukraine thing continues. No new really big headlines to talk about at this point in time. By the way, I mean, the S&P 500 has taken out some important technical levels, and it does suggest that there may be more buying which may come in, especially from funds in the systematic category. I mean, who basically flip long or short based on market levels, purely market levels, and that's a substantial amount of money which may start to flip back long. So, I mean, we'll see, we'll find out, but it does look like there may be a little bit more to go. Sonia.
Absolutely. And, you know, today, of course, the market is indicating that the start will be well in the green. But yesterday, too, right, there was buying across the board in the bluest of blue chip names, whether it's TCS, Infosys, Reliance, ITC, Kotak Mahindra Bank. So there was some basket buying that you saw, an indication that perhaps a risk appetite has come back into the market. Let's see whether it's something that is sustainable or not. But for now, here's some opinion coming through for you on the equities front. Dan Feynman of Credit Suisse is our guest. He says they have adjusted their Asia ex-Japan top picks in light of the Russia-Ukraine conflict. He says their global strategy is not bearish, but is less optimistic than before. Although it's not their base case, another jump in oil prices could hurt Asia harder than key global peers. Broadly, they are making 3 changes. They have increased China names and cut in India, added several defensive stocks and introduced a list of top Asia ex-Japan shorts. Within India, Credit Suisse has cut their exposure to the domestic economy by deletion of SBI, Ultratech Cement and L&T and inclusion of Infosys. Okay, that's interesting. So I guess they are underweight on the economy-facing stocks but getting bullish on IT.
Oh, yes. And Infosys is very close to its lifetime high as well. Let's get you some money market views as well then. Kunal Sodhani of Shinhan Bank says that risk appetite has increased despite continuing advance of the Russia-Ukraine conflict and a hawkish Fed. The US 10-year Treasury yields are at 3-year high amid aggressive US Fed talk. Brent prices have cooled off a bit ahead of the EU summit outcome on the embargo of Russian oil. For the USD INR, 75.85 acts as support while 76.35 is a resistance.
All right, and on the bonds, Dhaval Dalal of Edelweiss says sentiment in the bond market remains subdued, driven by a super hawkish Fed and rising US Treasury yields, even as RBI officials made supportive comments. Recent comments by FOMC officials have led to rising expectations of more than 150 basis points hike in 2022. Ongoing geopolitical crisis continues to disrupt global growth inflation outlook. They remain cautious and expect the 10-year bond yield to trade in a range of 6.8 to 6.95% in the near term.
Okay.